Money Radio for a really great future. We're talking real money.
Hello, friends. Welcome once again to another exciting edition of the Talking Real Money Radio show and then podcast. I'm Don McDonald in Florida, Tom Cox in Washington. You're wherever you are in the Seattle metro area or around the country listening online. Thank you, or around the world. Thank you for being there. We really appreciate you, and we want to help you deal with money better than you did before. And one of the ways we can help you do that is by sharing with you some of the dumbest things investors do to blow up their own portfolios.
Yeah, there's a lot of them, and thank our friend who will be working with at Retirement here in a few months, Christine Benz from Morningstar, to pointing these out, portfolio problems that she sees. And I have to agree with most of these straight up because I see a lot of your portfolios, and oftentimes you come clean before you even meet. You're like, I know I have that thing that Don McDonald talks about. What is it? It's that disease. Hodgepodge-itis. That's the first one. She calls it portfolio sprawl. Too many accounts, too many holdings, too much redundancy. We see it a lot.
You know, when we see Christine in March at Retirement, and by the way, it's in March this year,
yes,
we should tell her she is welcome to use hodgepodge-itis without any licensing fees.
Exactly.
She can use that as much as she wants.
This is where you have a lot of things you've purchased over the years. They sort of get stuck. You forget about them. And then you also believe this whole notion of don't put all your eggs in one basket. People believe, well, I have 10 accounts, so I don't have all my eggs in one basket. Well, they're all in the S&P 500.
Yeah, exactly. Well, they're all in growth and income. They're all in blue chip growth. Well, that's not eggs in different baskets.
No, it's not. And that brings me to number two. She sees the basket of large cap individual stocks. If I had a nickel, Apple, Amazon, Microsoft, et cetera. So then you own the S&P 500. Then you own these other stocks. Well, that's diversification. No, those stocks make up about 40% of the S&P 500. That's not diversification.
Now, if you own those stocks and the S&P 500, you have 50% of your portfolio in them.
Exactly. Or more.
I've
seen more where people have huge concentration. It wouldn't surprise you here in the Seattle area. People own a lot of Microsoft stock. I often wonder if they had stayed in Albuquerque if you'd own any. Probably not.
I didn't even know they were in Albuquerque.
That was where it all started. Then there's this other one that we see on a regular basis. We just started working with somebody who brought their portfolio in, and they had held this fund for 31 years. They purchased it 31 years ago, set up the portfolio, and just said, I'll just leave it there. And the performance has been crummy. The expense ratio is very high. It's in a taxable account and has a high turnover. So guess what? Been paying more tax on that as well. And this, at some level, that's a problem because it just creates, for one thing, in this case, it creates a problem of trying to sell out of the position because you've held it for over 30 years.
Yeah.
No matter how bad
it requires
the
a lot more
been.
planning to get out.
Yeah. But you end up paying a lot in fees you don't have to pay. And in this case, you've way underperformed just an index fund.
Yeah, and the other thing, though, is that over the years, and I'm a perfect example of this, the industry has changed from one that believed in active to one that has finally realized, based on data, that active doesn't work. And so we've got tons of people with old actively managed funds that aren't horrible. They're just not as good as they could be, or they're underperforming the indexes or the more passive products. And those changes need to be made at some point if you're going to have an optimal portfolio.
Yeah, exactly. Clean things up. And she makes this down the list. I think it's number one. Asset location, she says, not informed by the plan. What she's saying here is you tell us, oh, I'm a conservative investor. And then we look at your portfolio that's 90% in stocks and 10% in bonds. Oh, I don't want to take any risk in my portfolio. And then we see one that's 80% in stocks, 20. That's not what I wanted to do. Oftentimes people build the right asset allocation, right? The stock to bond ratio, 60-40, whatever. And then they forget they got to do that rebalancing thing because stocks over the long haul have made much more money than bonds. So you need to sell the stocks, buy some more bonds. Or they just never cared at all. They just built the portfolio not even thinking about, well, at some point I'm going to use this money, or at some point, let's hope it's not soon, the market is going to go down a lot. It may have started last week. We don't know. So you've got to start with the plan. We've talked about this a lot. If you have the plan, then you build the portfolio.
That's why we emphasize planning.
Exactly.
Planning is critical.
And so that's another one that I see almost every portfolio. Not everyone. Some, they walk in and they've done it all right and they thought about it. But most of the time, people build one and they sort of forget about it, which brings me to another one, which is very important. And that is suboptimal asset location. I hope that does well with the guy who said my vocabulary was so bad. Because asset location is important. Oh, okay. I was hoping for like a 25-cent word. It's so important, but it's overlooked. In other words, if you have taxable accounts and you have pre-tax accounts and you have Roth accounts, there's reason to hold specific types of investments in each one of those. Very few people do that. And in fact, many advisors don't even do. I've seen portfolio from managed where they don't even, no, we don't do that. We don't think that through. That is so critical because every one of those accounts has that partner. Who's the partner? That's right, the government. They want their piece. Give them the least they got coming, is my take.
Yeah, I found this to be a really, really powerful list. This is an article that Morningstar published, and it was back in September, but terrific information because these are the things we see the most. These are the kind of problems, and they're so easy to eliminate. You can eliminate the hodgepodge-itis. You can put things in the right place. You can have a plan. It's not all that hard. None of this is hard. 855-935-TALK is our number.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Well, he said he was going to hang around until the 20 break, but apparently he didn't. He skipped out early. So it's just me now. Well, me and you. You and me on the radio or on a podcast. And you can call me right now, and it'll just be the two of us talking at 855-935-8255. 855-935-TALK. And so unless you want a monologue, then you want to make a call. 855-935-8255. Let's go to the phones. It won't be a monologue right now because I have Rose standing by in Pierce County. Hey, Rose, welcome to the show.
Howdy.
Howdy. What's up?
I am looking for not specific advice, but generic advice from getting ideas on how one could protect themselves from what I believe is going to be the upcoming AI crash.
Don't own a lot of AI stocks. Don't own any individual AI stocks. And if AI companies crash, let's just assume for a moment they do, it's not going to kill the whole market. It'll hurt Nvidia. It'll hurt Microsoft. It'll hurt Facebook. It'll hurt maybe Tesla. A few of the tech companies, but it's, healthcare stocks, banking stocks, consumer goods stocks, all of these guys, they're going to do fine. And any kind of crash that comes about from an overhyped industry is usually relatively confined to that industry. And we're kind of seeing it all. We may be seeing it in the NASDAQ. I don't know that that's the case, but it's not. while it could, it's not likely to trigger a big collapse in the market. And if it does, your portfolio should be built to handle that already. It always should be built to handle that. You should have a portfolio that reflects your need to take and your ability to withstand or to sit tight through volatile markets.
So you wouldn't expect an AI crash to turn out like the 2001 crash.
I wouldn't expect that, because I don't think that AI has it's entered the entire economy to that extent yet, but eventually it might. But even if it did, that was a brief moment in the total market's history. If you had a globally diversified portfolio that was 60% stocks and 40% bonds, you made money right straight through the 2000s. It was a short blip. Like even 2008, which was much worse, by the way, was a short blip in the historical picture. You understand what I'm saying? You want to have the right portfolio now, but you want to have the right portfolio all the time. Your portfolio today should consist of somewhere around 10 or 15,000 different stocks around the world. They should be small cap and value and large and internationals, and then there should be some bonds in there. And if you have that kind of a portfolio, then let's say we had a 2008. Well, a balanced portfolio, instead of losing about 50%, lost in the 20% range and recovered within a year.
So going with something AVGE or something like that, just
for your equities, yes, ma'am. But again, just owning equities is still going to expose you to a big potential downturn in the market. So that's why we say you have equities and then you have CDs or bonds on the other side of the portfolio, not for the big money they make, because they don't. You own them for their relative stability compared with stocks. Well, if you own individual CDs and you have a CD ladder that you always disciplined reinvest, then you have a portion of your portfolio that is pretty close to absolutely safe, while the other part can be really volatile. It can make you a lot of money and it can lose you a lot of money. But the good news is, going back as far as we can go, if you invest in equities, if you invest in the global economy, you have always eventually made money. You just have to wait for it. Because there's nothing we can do in the short run. We don't know what's going to happen. We don't know that there'll be an AI meltdown. We don't know it. People are talking about it, but people talk about every potential downside in everything.
So how would you, if there were, would that affect the international market in the same way?
Possibly. Probably not to the same extent as most of the AI companies in the world are U.S.-based. So that international exposure is probably going to give you a little bit of ballast. But again, you really should have the right portfolio right now. You shouldn't be worried about what's going to happen, because you should have a portfolio that's built for worst-case scenarios where you don't have to do a darn thing. You should have a very large portion of your money overseas now, not tomorrow, today. Should have had it yesterday.
All right. Thank you. This has been helpful.
Well, you're very welcome, and thank you for calling. And if you would like to call, it's easy. And it's just me. 855-935-TALK is the phone number here. That's 855-935-8255. Give me a call. We'll talk about money, life, and all the things you do with money in your life.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And I'll be talking about real money with you if you call me. But you have to call me. 855-935-TALK, 855-935-8255. Tom has snuck off. His daughter's in a soccer game, championship soccer game in Washington State, so he's off to that, and we're here. So give me a call. Lines are all open for you. And it's really easy. And if you need help, I love giving it to you. 855-935-8255. And bear in mind, it's anything money-oriented. Don't just talk about investing. As a matter of fact, I read an article recently about this. I never heard it referred to as such. The term for hacking via text messages now is called smishing. SMS phishing, smishing. And you know, if you have a text account, you're getting smishes. Probably a lot of them. And these things, you've got to be very, very, very cynical about everything you get, skeptical of everything you get, because you'll get these notes from the Postal Service, from the toll authority there, from all kinds of people saying, well, you know, you got a package. If you want it delivered, you got to send us some money. You can't respond to any of these things. And it's fascinating how big it has grown and how easy it is to become a smisher. I mean, you can sign up and get software packages for $200 a month, and you too can become a spammer, a scammer, a smisher. And you can get it on sites like Telegram. It's just, you got to watch out for all this stuff. You've got to protect your money in so many different ways. That's why shows like this are kind of important. 855-935-8255. Give me a call. Let's go to Seattle. And Ann, you're next. Welcome to Talking Real Money.
Oh, thank you for taking my call.
My pleasure.
I need to warn you that I'm 80 years old. I'm a widow, and I have a portfolio that was designed by Schwab, and it has 9 different mutual funds in it, and they are all losing money to a total of $83,000. The total value is $725,000.
Okay.
So can you...
Can you give me the names of some of the funds that have lost the most money?
Oh, I'll be glad to.
Yeah, I'd love to know.
BCOIX, MANLX, JSCOX, PDBZX, PS1 or ILX, U11NX, 11CIX, WACSX, and SIGYX.
I don't know any of these symbols. Well, isn't that interesting? Let's look one up, shall we? Holy cow. Wait a minute. Is this a Schwab advisor was giving you these funds? Or was it somebody who worked for Schwab or an advisor?
Yes.
They work for Schwab.
A Schwab advisor before the pandemic. And because I'm a widow and I have a home, I'm always really, really busy. And so I'm looking at this and horrified. But yes, a Schwab advisor.
These are bad. They're really obscure.
Yep.
Touchstone small company Y shares with a 90 basis point expense ratio. This idiot needs to be fired. Sorry, but this is an idiot. Schwab. I generally have a high opinion of Schwab, but this is a terrible advisor. I mean, I've already gone through 3 funds. Are you in a really high tax bracket?
23%.
What's your annual income?
$104,000.
You're not in a very high tax bracket. All of these are high expense ratio funds that I've looked at so far.
I'm not with them. What actually happened is because of the pandemic, I had to help take care of my family, and Schwab dropped me as a client. So because I didn't come in for my annual meeting or whatever their requirement is. Yeah. And when I got back from home again with my family, I tried to transfer some money, and it.
Oh my God! Hey, hang on with me just a minute, Ann. I really want to help you get this straightened out because this is a mess. Everybody else, hang on for a little bit. Have patience. I will get to you. We'll be back.
Tom and Don are talking real money. Money Radio for a really great future. We're talking real money.
Here I ask you to hang on until I help Ann out, and you guys dropped off. Give me a call back, 855-935-TALK, 855-935-8255. Talking to Ann. Ann is 80. She's widowed. She has a portfolio that was created by an advisor at Schwab a while ago, but she got fired by the advisor at Schwab, or by Schwab. This advisor put her in a whole bunch of actively managed, very, very expensive funds, most of which were in the wrong place at the wrong time. They're actually in investments that have been doing better lately, but for a while didn't do very well, and none of them have performed admirably, and they're all really expensive. I mean, one of them is a Janus Henderson fund that is almost 1.2% per year. It's just ridiculously expensive. So, and I think if you've lost money, that would be strange, because I don't see that these funds over the period since COVID are currently down. They went down in 2022, but I don't see that they're currently down. But you haven't made much, that's for sure.
Well, in the gain loss column on their statement, it says minus 83,401.34.
Have you taken money out?
Well, I have to take the RMD, but that comes out of
see, that probably includes money you've taken out because you've drawn the portfolio down some. So that's not just a loss. That's actually taken money out. But this is a messy portfolio.
Yes.
It really is. I mean, you would be better off. Okay, where is the money being held now? Is it still at Schwab?
Yeah, it's still at Schwab, but they've made attempts to contact me about a new advisor, Minhouse, and
You don't want a new advisor at Schwab.
Yeah.
You don't want one.
Yes.
They've proven themselves to be bad.
Yes.
This is bad. This is a bad portfolio. It's a mess. It doesn't look like it. I mean, I don't know what the allocations are like, but I'm seeing there's an expensive small cap value fund. There's an expensive international fund. They're all actively managed. I mean, you would have done so much better if you were just in VT.
What is that?
Or the Vanguard Total Market Index Fund. Or in one of Vanguard's target date funds. This is just a mess. So one of two things needs to happen.
How do I get into VT Index Fund?
Again, I believe this is going to require a little advisor guidance from a really good advisor, one who doesn't sell actively managed funds.
Okay, like who? Your company?
Well, yeah, but I don't want this to sound like a sales pitch because it's not. But I know I would and I don't do this very often, but I honestly would suggest that you call our 800 number, which is 800-386-3004 on Monday.
Okay.
And talk to Tom. Just ask for Tom.
Okay.
Okay?
Okay.
And tell him that that Don said to call you because you have a mess. And he's probably listening in his car right now. And he's saying, have her call me. I can hear him saying that. Have her call me.
Oh, perfect.
Because this thing is a mess. It is ridiculously overpriced. It's a hodgepodge. It's nonsense. It looks like this guy was trying to pick whatever fund he thought would be hot at whatever moment he was selling it.
Actually,
I'm guessing. I don't know this.
Actually, it was not a guy. It was three women. Yes.
Three women got this wrong. Wow.
Yeah.
I can see if one got it this wrong, but if three messed up together, these are all really expensive, and it sounds like they're trying to justify their expenses. And I'm pretty sure they were charging you a fee because these are no-load funds, so they were charging a fee in addition to the fees of these funds. So they were your average expenses were probably running 2% a year. Really pricey.
No, it's true.
Really pricey.
It's true. Yeah.
Call Tom on Monday.
Okay, thank you very much. I will do that.
He will look at it and you know, it may be. I was so tempted to just say, go to Schwab on Monday, sell the whole darn thing because you really don't have much. Are these in IRAs or in a taxable account?
Wait a minute, I got to figure it out. It is in. I have both. I have an IRA and I have a taxable.
Okay.
I think it's in the IRA. I think it's in the IRA.
Oh, good. Then it's all going to be, there's going to be no tax ramifications of this. There shouldn't be much anyway because their performance has been so bad. But I would just unload all of these funds and get like a target date fund. I'd get a target 2025 fund, which is going to put you about half stocks, half bonds. And it's a really well-diversified portfolio. And you don't pay anything for it. It's like 0.1% or something.
Okay.
Ridiculously cheap. Anyway, this was some bad work on the part of a Schwab advisor.
Yeah,
and there are bad advisors out there. There's a lot of them.
Yeah, I thought they're going to be reliable.
Well, again, I think so highly of Schwab as a custodian and a brokerage firm.
Yeah.
But when you got people who want to appear to be experts, they don't like to do boring stuff. For some reason, they feel like they've got to do all this exciting, complex stuff when it would be better to just be boring.
Oh.
And I wish more advisors would adopt that philosophy. I'm not trying to beat the market. I just want to be the market. I want my clients to just be in the market. That's all. And I want it to be right for their risk tolerance. And this isn't feeling right for your risk tolerance either, although I don't know a lot about it. You might, in the interim, go to talk. Do you have internet access?
Yes.
You get on the internet?
Yes.
Go to talkingrealmoney.com.
Yes.
Our website.
Yes.
Scroll down and take the risk quiz.
Okay.
Before you talk to Tom, that'll give you a risk score, which will tell him a lot. You'll be able to say, okay, I took the risk quiz and here's what it said. And then go from there. But thanks so much for the call, Ann. I really appreciate it. And I hope this works out for you. 855-935-TALK is our phone number. I do have lines open. Lots of time left. Please, those of you who dropped off, go ahead and call
Tom
back
and Don
right now.
are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Ann's call is just so illustrative of this industry. And honest to goodness, I hate the fact that the financial services, the investment industry generally stinks so badly. It's just generally awful. It's appalling. And I wish it wasn't. I wish I could just say, go to any fee-only advisor and you're likely to get great advice. Then I wouldn't feel like I was trying to sell you on our firm because I'm not. I mean, I think we do good work, but I would like to think we're not the only ones doing it. But then you have a situation like this where you've got a company like Schwab, great reputation. They do fee-only advice. So these were fee-only advisors, fiduciaries, who recommended a bunch of bad funds. Really, and some of them ridiculously aggressive, and all of them too expensive. I don't think I saw one that was under 0.4% in annual fees, and that was a bond fund. This industry really, and I think the biggest reason why this industry stinks is because we as clients expect them as advisors to give us advice that is magical, that is better than everybody else, that's going to put us ahead of everybody else. And our philosophy has always been, and I do literally mean always, getting the market is actually getting good, because most people don't even do that. 855-935-TALK is our phone number, 855-935-8255. Back to Seattle. And Jeff, you're on. Welcome to Talking Real Money.
Hi, Don. I have just a general philosophy question from you, if you can. So for someone think of a married filing jointly couple in their early 60s, and about 70% of their assets are in a traditional IRA account. Any advice? You've probably gotten this question before, so apologies if you're answering it again. Strategy on Roth conversion and your sense of how to guide there.
Well, I've gotten the question before, but that doesn't mean we shouldn't get it again, because we all need both reinforcement and repetition. And there are also new people listening, so it's a good question. So 70% of your money is in a traditional IRA, and what is your current tax bracket or income level?
24% tax bracket.
24%. And have you done any retirement income planning? Do you know about when do you expect to retire?
Probably, the normal retirement age.
65?
67, I guess. 65-ish, yeah, something like that.
Yeah. And what do you expect your income to look like in retirement? Do you have a pension?
No.
Social Security then? Social Security and your investments?
Yes.
Do you expect that the income that you're going to derive from your retirement monies will be less than you're making now from your employment?
No.
Okay, then. It probably you'd be a candidate for a little bit of conversion. You want to, because it's nice to have two different pots from which to draw. So you've got the taxable account, which I would imagine is the other 30.
Yep.
You have the taxable account from which you will draw in the early years. Then the IRA will kick in later years, particularly when you get to RMD age. Then you'll leave the Roth alone forever, or at least until you desperately need it.
Right.
So I would start probably this year with a little bit of Roth conversion. Just make sure you do some tax planning so that it does not kick you above that 24% bracket.
Okay. Because it seems like
if you're going to be in the 24% bracket or the equivalent, then why not? I'm sorry, what was the question?
It does seem like the smart thing to do in the long run. But it seems like the benefit that you get really doesn't materialize until after, age 75 and the RMDs start kicking in.
That's right.
Yeah.
Yep.
Yeah,
it's a much older age, and it's a minor benefit. Okay. If you didn't do it, I don't think you're going to suffer anything for it because basically yours is a wash. You're going to pay it now or you're going to pay it later.
Yep.
But there's a lot of uncertainty about later. There's a lot of certainty about now. Now you can control your bracket because you know what it's going to be this year. 10 years from now, it could be worse, could be better, but generally speaking, taxes don't tend to go down a lot.
Right.
So I think I'd play it safe because you're going to be in the same situation. If you had said to me, no, I make more money now and I put a ton away, I'm in a much higher bracket, I'll probably be in a lower bracket in retirement, then I would say leave it the heck alone. Keep contributing to your tax deductible accounts and don't worry about the Roth. But you're in a situation where there might be some minor benefits to the Roth. They are not large, though.
Okay.
They're not likely to be large. Okay?
All right, that's helpful. Thank you.
Thank you very much. I appreciate the call. We still have some time left if you can call quickly. This is your only chance, by the way, during the week to give me a call. 855-935-TALK is the phone number, so we'll have a couple minutes after this break. Otherwise, you can send your questions in at talkingrealmoney.com on the contact form, and then we answer those on podcasts throughout the week if they're typed, and on the Friday Q&A if they're spoken.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
For your real life and real future, Tom and Don are talking real money.
I was just during the break. I recently read an article about gold versus Bitcoin. In fact, there's been a lot of noise about the difference between, because gold's been running up because of the weakness of the U.S. dollar. And there's also been a lot of talk about how Bitcoin is a great substitute for the U.S. dollar. That's one of the big arguments that's made in favor of Bitcoin. But I've just been looking back at the past few months, and gold's held up really well at around over $4,000 an ounce. But I hadn't looked at Bitcoin in a while, and I looked at the chart for just Bitcoin itself, and in the last month, Bitcoin has lost about, well, let me just double check. I want to make sure I've got my numbers right because I'll get yelled at. Yeah, almost 19% in the last 30 days. Gold is down like 2% in the last 30 days. Here again is one of my biggest issues with Bitcoin and cryptocurrencies. You want stability in a currency or a currency substitute. Now, gold is considered by many to be a currency substitute. I can see why it was a currency for such a long period of time. And it is a little bit volatile. It's more volatile, I would say, than the U.S. dollar has been historically, or the pound or the euro or whichever currency we're talking about. But Bitcoin has taken, and it continues to do so steadily, has taken volatility, upside and downside volatility, to levels you don't see with any other asset class. You'd think the most volatile asset class was stocks, but rarely do stocks make 50% swings over the course of a year. With Bitcoin, that's up and down, kind of normal. So this is another one, and I know that all these Bitcoin proponents are going to be mad at me again, but I just don't see why anybody would want to use a currency that bounces around that much. I wouldn't want my dollar to be worth 18% less today than it was 30 days ago. Might be worth a fraction of a percent less than it was 30 days ago, but almost 19% less? No, I don't want my currency to be that volatile. I don't want to live in the Weimar Republic, or the modern version thereof. So anyway, just wanted to share that with you. Thank you so much for being a part of this live program that becomes a podcast. And please, if you get a chance, tell other folks about the show. We really do want as many to listen as possible. It's not a finite resource, so we can have all the listeners we want. And if you have questions, remember, you can call us on Saturdays, 855-935-TALK, but that's just for 2 hours. If the questions come up at other times of the week, go to talkingrealmoney.com. There's a Contact Us button in the corner. Click on that. Either speak your question, those go on the Friday podcast, or type your question, those go on other podcasts, and we'll get those answered. And if you need some help from a real live fee-only fiduciary advisor for free, for nothing, no obligation, go to talkingrealmoney.com and click on that button that says Meet an Advisor.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's as fees and services. Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.